Good afternoon. My name is Iris Chung. I'm a senior manager with Eide Bailey in the SALT group. I have over 20 years of experience, but I've been with Eide Bailey for just over a year and a half. My experience has been in public as well as working in-house. I will let Kelly and Greg also introduce themselves before starting the presentation.
Hi, so I'm Kelly Williams. I'm a certified NetSuite administrator here at Eide Bailey. I am an optimization consultant on the managed services team, and I have a couple years of experience with specifically tax configuration in NetSuite, as well as integrating Avalara and NetSuite. And I'll kick it off to Greg from Avalara.
Hey everyone, I'm Greg Carruthers, and I've been working at Avalara for about 6 years now, and I manage a team of people that oversee our partnerships for accounting firms. Pleasure to be here. Looking forward to speaking later.
Sales tax trio, starting with this year, in the changes of the last 3 states to have passed the nexus thresholds, economic nexus thresholds for the year. They're Kansas, Florida, and Missouri. Kansas in the past had required all out-of-state sellers to collect and remit sales tax to the fullest extent allowed under the U.S. Constitution. As you may know, that state was contentious because the department had come out with this rule, and then the AG's office refuted and said it didn't comport with the Wayfair decision, and then the governor went ahead and endorsed the department's rule. So now, as of Senate Bill 50, which passed on April 16th of 2021, the state now does have a nexus threshold of $100,000. And that is for $100,000 of sales of property or taxable sales in the prior or current calendar year. This bill passed, was vetoed by the governor, and then the lawmakers overrode the governor's veto on May 3rd this year. And so that's how it passed into law. For Florida and Missouri, they were the only 2 states before that maintained a physical presence nexus standard for out-of-state sellers of taxable goods and services. Florida enacted Senate Bill 50 on April 19th of 2021, which expands the sales tax reporting requirements. So again, a $100,000 threshold effective this year. Missouri has legislation. Actually, it's been delivered to the governor as of the end of May. It's still pending approval, but it's passed both houses, Senate Bills 153 and 97. The effective date of the legislation is delayed until January 1st of 2023. The reason for that is to give the local jurisdictions enough time to have elections and implement a use tax. Missouri has the greatest number of local taxing jurisdictions in the US. Of over 14,000 local jurisdictions, more than 2,000 are in Missouri. So this is to allow enough time for them to implement a system to be able to enforce and also draw up the laws required for compliance. So in this case, we will move on to a couple of examples on what generates or what creates nexus. An equipment company leases, based in Arizona, leases a crane for a construction project in Washington. The contract price is $500,000. Washington imposes an economic nexus threshold of $100,000. Do I have nexus? Of course you do. But then there's other questions. Well, what happens if this is just one construction project? You don't anticipate having others. Does the Arizona company continue filing in Washington? Do you cease filing in Washington? Things to be aware of are trailing nexus, which means that for the year or 2 after a company ceases to register or withdraws, they would be subject to tax on any sales in those subsequent years. This may not matter as much for a construction company that leases large size equipment for one-off construction projects, but might actually have an impact on retailers, which might have an increased number of sales in 1 year, significant sales, and then might drop to 1 or 2. Those 1 or 2 sales would be technically subject to tax. So it's important to give some thought before withdrawing from a state for sales tax. So do I have nexus? This is a retailer. The merchandise is shipped from an Arizona retailer by common carrier to California customers. California has an economic nexus threshold of half a million, and the contract price is $100,000. You don't have nexus, but what happens if the product is shipped by delivery trucks? In many states, in all states, that creates physical presence nexus. So it's important not to forget that not only economic nexus, but physical presence nexus creates a nexus and a filing requirement in the state. The other thing is whether you have warranty repairs on where you might have independent contractors that are performing warranty repairs within California. If they are, that also creates physical presence nexus. Are the states hunting for remote sellers? Well, I guess that's an easy one to answer, but how are they doing it? There's many ways in which a state is pursuing remote sellers. I'm going to take just a brief discussion on Texas. Texas will cross-reference, as many other states will. North Dakota does as well, and many other states, Wisconsin, Missouri, Minnesota, other ones that aren't on this list. They'll cross-reference between franchise tax returns filed and whether or not a sales tax permit has been filed. And oftentimes companies will get a notice on that. In North Dakota, cross-referencing between withholding and sales tax permits is very common in other states as well. So with this environment where we have a lot of businesses that have remote working employees that are continuing to expand in other states and may even be permanent, it's often good to reassess whether or not those companies are subject to income tax and whether sales tax registration is required. So the first category and the fourth one on California, Pennsylvania, Massachusetts, and New York all are in common with the fact that Amazon may have warehouses in these states and they're holding inventory for your remote sellers. And that has generated, because Amazon has provided lists to the state, has generated numerous notices for remote sellers. And in California in particular has been very aggressive. And they've gone back to as early as 2012, pre-Wayfair, sending notices and asking remote sellers to remit back taxes. And it's not aligned with the fact that the state passed their marketplace facilitator requirements to collect tax in 2019. So they're going beyond that period of time, back to the earlier years when they knew that the remote sellers had inventory in the state. One particular case is Rubinas Maduros v. Maduros, which was a case that is right now before the Northern District of Illinois, a U.S. District Court. And that case, the remote seller actually was levied, the bank account was levied on her business. And the California Department of Tax and Fee Administration actually levied $2,400. So right now there's a preliminary injunction action to try to get that money refunded. It's a current ongoing transaction, and this is only one case of several by the Online Merchants Guild, which is pursuing actions against California for seeking back taxes. So the complexity of sales tax doesn't end at the local jurisdiction. In fact, that's where it starts. Local jurisdiction taxes are imposed in many states. The complexity is that in these last 3 states, there wasn't centralized filing. Alaska is an unusual state because it doesn't impose a state tax. It imposes local taxes. So there's a municipal league that has actually created a model act and also enforcement on economic nexus standards of filings in a centralized, and they're focused on developing more administrative systems and also sales tax compliance software to be able for remote sellers to comply. Colorado in 2020 launched SUITS, which is the sales and use tax system that provides businesses with over $100,000 in retail, one avenue, one system to register, file, and remit. Arvada and Denver have joined on this. It's at the it's voluntary for the local jurisdictions to join. However, that is the way that they're able to implement economic nexus, and so that provides a strong incentive to join. Right now, 44 of the 71 jurisdictions have joined. Louisiana is one of the last to implement a single state sales tax collector. Local government officials have been very protective of the revenues and wanted control. As you know, in Louisiana, they have parishes. And in House Bill 199 that went into effect on June 14th this year, enacted a streamlined sales tax system. However, it's not going to be implemented until 2023 because the state constitution needs to be changed and there needs to be a creation of a state and local streamlined sales and use tax commission. So that will have to go to vote at November 8th, 2022 election. Right now, though, Louisiana does impose an economic nexus threshold, and they have a centralized unit online for voluntary disclosures. So that is something to keep in mind. So what happens with there's a lot of inequity because we have marketplace facilitators that do need to collect tax and remote sellers that now it's been the third year since Wayfair, and marketplace sellers and remote sellers are collecting taxes, but not enough of them are. So in this case, there was a local appliance store owner in Illinois who actually sued Lowe's and all the 5 big box retailers in Illinois. And it was through the False Claims Act, which is the Whistleblowers Act. This allows an individual or non-governmental organization to file a lawsuit in US district courts on behalf of the US government. The judge entered a decision against Lowe's, finding liability on March 31st of this year. So Lowe's could face $10 million in back taxes, trouble damages, interest, and attorney's fees. What's the reason why? Why did they pay less in tax? Well, they took the position that they were a contractor, not a retailer. Contractor would be subject to a use tax of 6.25% instead of the sales tax rate, which could be up to 11% with local taxes. And they asserted that they were, and they also charged tax. They collected or they remitted tax on the wholesaler price, not the retail price. So the interesting thing is, under the False Claims Act, you violate it by knowingly making a false record. There's evidence, if there's evidence of reckless disregard. So in this case, the judge held that having a PwC tax opinion that was contrary to Lowe's position and not paying the higher tax, that was evidence of knowledge or reckless disregard. So Best Buy and Home Depot could face a similar fate. So stay tuned on what happens next in this case. In the interest of time, I'm just going to talk about a couple other things. Maryland, Maryland has had 2 significant changes. One is that they now tax digital goods, and digital goods it is defined as digital product or a digital code. Business tax tip number 29 was republished on June 3rd, 2021. It provides a lot of examples of the different type of transactions that are subject to tax and expansive definitions of what a digital product or digital code means. Of importance, I find that the off-the-shelf software is actually included as a digital product. Sales of software as a service could be exempt if it's customized software. There are examples depending on how you need to configure the software for the customer that it could be deemed customized software and exempt from this tax, the sales tax. But it depends, and it seems to apply on a case-by-case basis. The digital advertising tax. Maryland is the first to impose a digital advertising tax. And this tax is imposed on large tech companies, on advertising platforms like Google, Amazon, Facebook, Microsoft. So what does that mean to the small advertisers? Well, the costs are they cannot be lined items on tax as a tax passed on directly down to the advertisers as a surcharge or a line item. But it doesn't mean that the cost will not be incorporated. What's interesting is that similar taxes have passed in the UK, Austria, France, Turkey, and in those countries, the advertiser platforms have actually passed those costs on to customers. So this is something to be aware of for advertisers and advertisers' customers, that these costs may end up being increasing the price of advertising. Lawsuits have been filed against this particular tax by the large tech companies, waging US constitutional challenges. So there's more to come on this. Other states have also have pending legislation: West Virginia, Texas, Massachusetts, New York. So there's more to come on this as well. So I touched upon a little bit of income taxes. And when you register for sales tax, you also have to be aware, as we mentioned before, that there's cross-referencing and that states may send notices and they actually have either income taxes or they might have a gross receipts tax. So it's possible that your company will be subject to tax on the income and gross receipts tax. So it's good to know what your state tax profile could be. So before registering, just beware of outstanding potential liabilities. How long has your company been generating over $100,000 in sales, which is the standard Nexus threshold for sales tax? Would you want to consider a voluntary disclosure agreement? I guess it would depend many times on the amount of potential liabilities that you might have, or your company may be interested in selling, at which point you would want to know what all of your exposures might be. A checklist for entering into a new state includes payroll taxes. There's head tax reporting, which is in Colorado. Colorado imposes the occupational privilege taxes at the local level, so those are good to know. What the actual employer and the employee have responsibilities on that. Sales tax licenses, where and what jurisdictions do you need to obtain these? Corporate franchise tax reporting. Is the state a home rule state, like a Colorado or Washington or Louisiana? Washington also Seattle has a separate reporting for the business occupation tax, which is a gross receipts tax. There's also unclaimed property, dormancy periods, typically 3 years. But that's good to be aware of because there's lots of penalties associated with non-filing, as well as business personal property reporting laws. We can help you with putting together an assessment of what your nexus is and where you might be required to file.
Thank you. So thanks, Amy. So my presentation is going to be pretty brief. And so before I let Greg take over and discuss the Avalara portion of this presentation, I just wanted to speak briefly on how an ERP can help you better manage and automate your tax calculations and reporting. Sorry, took me a second to switch the screen. So having an accounting software to manage your customers' items and transaction records all in one place creates a unified suite to manage everything from customer exemptions to tax reports, and allows you to track your transactions from sale to fulfillment through billing. An ERP will help eliminate manual bottlenecks and give you access to both native and custom reports and workflows. These built-in workflows can help automate processes, orchestrate approvals, and enforce business rules. So beyond the standard automation that an ERP provides, it can also automate tax calculations. An accounting software will look at both the customer and item record to determine taxability. It also provides a place to manage your nexus and tax accounts. NetSuite and other ERPs also integrate directly with products like Avalara to create even more automated processes and provide additional audit and controls. These audit and controls give you access to system notes and audit logs that help you provide you with information about who made what changes and when. ERPs can also provide you with better visibility into analytics by bringing you real-time reporting and KPIs to user dashboards. These are also very customizable. An additional benefit to an ERP is document retention. So they have the ability to house your tax exemption certificates and have them visible on the customer master for a single point of reference. And so with that, I will hand it over to Greg from Avalara.
All right, thank you so much. So I get the pleasure of tying all this up, taking everything that we just spoke about and how does this all come together. I work at Avalara, obviously, which is one of the providers that can connect into NetSuite or many other ERPs for this tax automation. And what we did is we actually went out and surveyed a few thousand of our customers about why they choose Avalara or an automation company. And here's what we saw. And for me, when I look at this, I thought it was very interesting that there's definitely a big lead as far as keeping up with tax challenges. And really that shouldn't be very surprising. If you think about the first chunk of this meeting, we talked about all these changes and how crazy some of them are. Just imagine trying to keep track of all of that. And it's just, it never seems to be getting better. It only seems to be getting more complicated and worse as time goes on. But one thing that is pretty surprising is the next grouping are very close in ranking. And what that tells me is it's very specific to companies. The companies are feeling different pain points or different reasons where this has become too big of an issue to continue to manage in-house or just leveraging some of that ERP out-of-the-box functionality like you've seen just a moment ago, and taking that extra step to get things a little bit more accurate and a lot easier so that you can start saving time. So what does sales tax really mean for your companies? We just heard kind of the nitty-gritty about all the issues that come from it, but at the end of the day, this is going to boil down to increased time managing all of these requirements. And that is not going to be just finance or a single department. We see this spreading through IT and other areas of the company, operations, for example, where business practices are having to change in order to accommodate these new laws. I'm also seeing a lot more increased tax exposure, right? We talked about how these new economic nexus laws are forcing companies to get registered in additional jurisdictions. That's leading to more tax being collected, which increases that exposure and makes sales tax a bigger area of focus for companies to make sure that it's right to avoid any risks there. Processes simply not scaling. This happens all the time with acquisitions or rapidly growing companies. And one that I hear almost every day is that fear of the unknown. This is what people are starting to lose sleep about. they know that the laws are changing, but they're just not confident that their company has been able to stay up to date with those changes. So what Avalara is able to bring to an organization is improving the accuracy through real-time calculations that's connected to the accounting platform, to the website. Think of any place where your customers or your employees would need to see a tax calculation. That's where the technology would get connected to make sure that you have a very accurate calculation there. Efficiency through better reporting and a centralized place where you're able to make one tax change that then goes to all the different systems. So it's centralizing everything. And much better visibility to how that risk is being managed within the organization. And now that we're starting to see a lot more global, customer experience is coming up more and more as an issue for companies. You can imagine if your company or organization is shipping product overseas, or maybe you yourself, if you buy something from a company where they're shipping that across a country line, if that product is getting held up in customs or duties, this is having a big impact on their customer experience. And with social media only getting louder and bigger, customer service is becoming a big concern, and tax is a big part of making sure that we can keep customers happy. Okay, so let's talk about the fun stuff. Let's get into the details, how this is really working. I wish I had time to go through and give you a full demo of what Avalara looks like, but to cut right into it, let's talk about a couple high-level points that people always, these are like those wow moments. We're like, wow, I just didn't know things like this were possible, or this would have made our life so much easier if we had this before. First one, economic nexus. We spent a lot of time talking earlier about how each state has their own rules, these thresholds, it varies from state to state. They're changing from time to time, making adjustments to those. Avalara understands this complexity. We have built a very easy to use tool. Think of a map of the US, and as your company is approaching 80% of a threshold, we will light that state up for you so that you can then see this is something to put on your radar, and it is coming up in the future. And then once you're at over 100% of that threshold, we'll light it up a different color. So you're getting insights just by logging into the portal, just by looking at this, no work or effort from your own. More accurate tax rates is another thing that always comes up of that wow moment where maybe you're shipping to other companies or customers that are outside of a jurisdiction. I just helped a company earlier today that was selling to airports, and airports a lot of times have their own tax jurisdiction right around them. And every time they're shipping there, the system was turning back the wrong tax amount. So they had to get a solution like Avalara that has all those jurisdictions right down to the rooftop level and not just a zip code, because within one zip code, as you know, there's several different tax rates in there. All of these tax rules constantly changing. I saw a slide, it kind of got, went through really quickly earlier on the presentation about gloves and these different nuances. All of that gets managed by Avalara. We have a team of professionals that would just be managing how things should be taxed, when they're not, if there's special tax rates that apply to them, if there's tax holidays. All of that is automatically managed in the background, so companies would no longer have to worry about that. Compliance documentation is a big part of it, and starting to see that more and more, especially from manufacturing clients that maybe we're only used to collecting in one state and not really collecting any tax at all. Now having a big burden of being able to collect documents and being able to get all the required reporting sent into all the jurisdictions. And at the end of it, this is only useful if you can use it, right? So, I've worked at Avalara for a while now. In the time that I've been here, I've been able to see a lot of different enhancements with our software. And while we were building it and trying to make our interface more user-friendly, we were bringing in people off the street, or like spouses or other employees, like significant others that worked at Avalara, they would get to come in and beta test this. And these people are not CPAs. They don't really know anything about tax. But when we built our technology, it's with that kind of mindset is you don't have to be an expert to use this. It's very intuitive and it's all broken down so it's simple. And anyone, even a new employee that comes in that maybe you're hiring because of turnover or whatever, they would be able to come in and get up to speed very quickly and easily on this. Okay, so, you know, there are a few other competitors in this space. It's kind of an interesting space. There's not many companies that do what Avalara does, but we are a relatively young company, founded in 2004. But in that short amount of time, we have actually acquired more customers than all of our competitors combined. Some of the reasons for that are right here. Big one for companies is the 800 pre-built integrations. So what that really means for your company, if you guys are using NetSuite and you have maybe a Magento website or a Suite Commerce website, you have a lot of options. Whichever platforms you're using, Avalara most likely already connects to those. And that allows you to get live on the solution much easier, much faster, much smoother. Digital global commerce. Avalara has been investing a lot of money in this. We're seeing it more and more where companies are selling to more countries and starting, you know, the internet is really making this a smaller world and product is moving all over the place. So we have to be able to accommodate all the complex, you know, duties and tariffs and these fees that come up whenever you go across a country border. So having all that built into the system and all together. Battle tested solution that's going to be extremely reliable. Avalara is now at the point where they're managing, you know, billions of tax calls, as you can see here, during Cyber Monday and these other holidays where companies are just constantly getting tax calls from our system. It's very accurate, and we have third-party hosting to make sure that all of your customers' information stays very safe and secure with these tax transactions that are happening. So no data has to be worried about getting lost or potentially impacting that customer experience for you downstream. I touched a little bit on this earlier with manufacturing companies that are now having to get registered in many different states. A tool that is not talked as often about is what Avalara calls Cert Capture. This is a very powerful document management tool that's primarily used for managing exemption certificates. It's also used for collecting and managing W-8s or W-9s for companies. And this allows you to digitally do that. We even have no touch options where your customers can provide their certificate without having to work with any of your team to get that into a system or get, you know, to keep track of that. Within the system, it's able to manage when these certificates need to get renewed. We can even check to see if they're valid against state guidelines and laws. So this, if you're a company out there and you are currently collecting certificates, maybe you're storing those in a binder or in some kind of file cabinet, this solution is a huge game changer, and it's just, you know, really impressive to see the things that you could do with that. So, you know, thank you for listening to this.
Yep. So before we do end, though, because we want to get our CPE, I believe, Iris, you're going to go back and cover a few things in the beginning.
Yes, I'd be happy to. So given that the sales tax rules are always the most complex of all of these sales tax pieces and involving compliance and nexus, I'll go back to a discussion that I skipped as a topic, which is the personal protective equipment and supplies, which obviously became a very focal point of whether or not these items were taxed, especially by businesses, which have had to buy physical barriers, offer face masks, disinfectants. Most of those products are taxed. In Pennsylvania, though, in this case, it was face masks that are generally exempt as medical supplies and clothing. Also, the governor issued an emergency disaster declaration on March 6th, exempting protective face masks from sales tax. Nevertheless, there was a company, Ulta Salon Cosmetics and Fragrance, that continued to charge tax, 6%, on face masks. The plaintiff went in and purchased two, which was charged sales tax, and is filed as part of a collective class action against, arguing that it's a violation of the consumer protection law. Well, what's the point? What does the plaintiff want? Well, the plaintiff believes that the class members are entitled to $100 per violation, which amounts to $2.5 million of statutory damages, and with reasonable costs and attorney's fees. So this action was actually filed, and then Ulta wanted to remove it to federal court under the Class Action Fairness Act. And on April 15th, the court decided to remand the case to the Allegheny County Court of Appeals, of Common Appeals. So this is still a pending case. So Ulta actually indicates that it probably charged sales tax on approximately 25,000 sales of face masks. So it's a significant amount, and is another example, in addition to the False Claims Act, of how taxpayers can seek relief outside of the tax laws. So with that in mind, there was also an interesting Bloomberg article that came down today about how 3 years after Wayfair, state revenue agencies are starting to get really serious on how they're going to pursue taxpayers. Taxpayers are not compliant with remote selling and economic nexus registrations and filing thresholds. So here's a few numbers. There was $760 billion spent on online sales last year. $35 billion of sales tax was collected in the states in the year. 2.1 million online merchants, and approximately 1 billion of a gap in revenues. So there's still a significant number of that 2.1 million that haven't complied or are not aware that they have to comply. So states are getting creative or resorting to other methods of pursuing non-compliance. Arizona has gone as far as hiring ASR Analytics, LLC, a Potomac, Maryland-based company, to do data mining, financial investigation, to define and identify companies. And they anticipate they could probably generate 100 leads a month. So other states, Wisconsin, Minnesota, California, Massachusetts, Washington, they all are aggressively targeting sellers, if we talked about. Illinois and Maine frequently send out assessments. Once a taxpayer has registered, they'll indicate that they likely have back taxes that are owed as well. So it creates a very complex, muddy situation for compliance. And I think one of the recommendations that we always make is to take it one step at a time, assess where you're taxable, and determine how you'd like to come forward, how your compliance, how to comply, what sales tax software, what would be the best fit for your business, and take the assessment as to what your actual liabilities are. So let me just also, on the personal protective equipment and supplies, as I said, most of it is subject to tax. Michigan has passed 2 bills that are pending before the governor to offer a sales tax refund for personal protective equipment. Virginia has a temporary exemption for personal protective equipment, and that was in effect and passed in March 11th of 2021. So both of these, Michigan and Virginia, there are potentials for refunds. Okay, and just to leave you with a little bit of more interesting sales tax tidbits. Arkansas, generally residential water service is taxed, but Arkansas provides an exemption starting in October 1st of 2021 for exemption for water that's used for chickens on poultry farms. Nebraska exempts residential water service. And interestingly, in California, there's a regulation that actually subjects to tax the sale of a partnership interest, and that's based on a regulation. Typically, the occasional sale exemption may apply in the sale of a business, but in the case of California, it rarely does apply because you have a seller, typically sellers, they cannot hold a seller's permit, and typically sellers do. So that occasional sale exemption usually doesn't apply in California. And the sale of a partnership interest typically is an intangible interest. Intangible property would typically not be subject to sales tax, but there is an unusual regulation in California that addresses the taxability. Well, that ends my presentation. I'm happy to have the last word on this. Please feel free to pass any questions on. And we look forward to speaking with you again.
All right, we do have 3 minutes we need to fill. We do have one question. Go ahead.
Yeah, so maybe you can compile any other questions out there, but from doing many of these webinars, one of the common questions that always comes up is, around pricing. And another common question is, how long does it take to, let's say we want to do this, how long does it take to get this all stood up and automate things and get it going and get it off our back? So let me answer those two questions, and Amy, I'll let you see if there's any other questions out there that we would happily take after, I'm sure, as well. So the first one is around cost. So Avalara is a software as a service solution, and the pricing of this solution is, I don't want to say specific to a company, but specific to the types of systems that a company is using. So for example, if you're using NetSuite, which is a great ERP because you can download apps very easily and it's easy to implement that is going to be less expensive than, say, a different accounting platform that's highly customizable and maybe is going to take more work to get stood up because of those customizations. So it is very specific to your company because we're looking at what systems you will be using. We're also going to look at the type of data that's coming through. Are you a wireless company that needs telecom taxes, or are you a manufacturer that's collecting certificates? They're going to be very different pricing. So it is very company specific. Maybe I should say industry specific is a better word, but Avalara does reach across all industries, fuel, excise, telecoms, all the sales and use tax companies, and all the exempt manufacturer type companies. So that's a little bit about pricing. We can definitely get you pricing. It's easy to do. We just need to have a call to understand what systems you're using and what type of technology you're going to need to leverage to make sure you're getting the right tax calculation at the end of that. Now for implementation. So that is going to be, again, a little bit specific to those types of systems that you're using. From most projects, what we see is roughly between 30 to 90 days. And a company that's going to be closer to that 30-day mark, more simple, maybe they're only doing tax in the US. So that definitely streamlines it. US and Canada, I should say, they're both very easy. If you're in other countries and it's really a global tax solution you're looking at, you're probably more around that 60 to 90 day time frame. And again, if you have a highly customized system, there's going to be some extra integration time potentially there as well. But a good just frame of reference that I can generally say, I know we have a ton of people on this call, but you could figure between 30 to 90 days is typically what we'd be looking at. Amy, are there any other questions out there?
There is one. Let's see here. Okay. If I have a long-term contract, 3 years, for example, with multiple hardware and software products, can a company collect sales tax at the end or as it's billed?
Typically, you would bill the sales tax with the invoices, over the 3-year period. That's how it applies. And it obviously would depend on what aspects of the contract are subject to tax. If you need more detail on that, feel free to reach out to me.
Yeah, and I was just on a really interesting call yesterday. A similar type of question came up. It was a medical device company, and it's so hard to answer this with over 100 people on here listening. So definitely, I'd recommend you reach out because one of the things that we were talking about on that call is the medical device is exempt, but there's a software component that goes with that medical device. And because of how they were putting it on the invoice being a bundled transaction, also was impacting the taxability in some of the states that we were looking at. So, these are really great questions, but it's definitely worth a more in-depth conversation. So I'd encourage you to reach out to your team at Eide here